Welcome to Part 2B, the use of guideline public firms to determine private firm enterprise value. In Part 2B, we continue to look at how the theory is put into practice, a quantitative approach to adjusting public firm multiples, presented by Dr. Stan Feldman.
Okay, now that we have set the stage in terms of what the multiples tell us, how do we use this multiple valuation or the multiples, I should say, to value the private firm? So what I would do is go back to the Gordon-Shapiro model. And remember, V is equal to the NOPAT margin times 1 plus G divided by K minus G. So G is what we've calculated in our simple example here, 6.45%. And the K is, let's say, for a typical private firm is 15%, just for purposes of this example. It could be slightly less, certainly it could be a good deal more, but let's assume it's just 15%. So what do I know from the private firm? Well, the private firm, I know its profit margin, right? So I know the NOPAT margin. I know its cost of capital because I've calculated that, and there'll be another video which will show you how to calculate the cost of capital, but just for the moment, say it's 15%. We have the NOPAT margin, and we have the 6.45% from the multiple analysis. Now, if I look at the 6.45%, as I said, that's an average for a particular guideline company, and for each guideline company, that G is going to be slightly different. So let's just assume I take the G's I calculate for all the guideline firms, I average them or find the median growth rate, and just assume for the moment that median growth rate is 6.45% with a cost of capital of 15%, a margin of, let's say, NOPAT margin of 10%, and then we can go ahead and calculate what the multiple would be, and then we would use that multiple to value the private firm by simply multiplying that multiple by LTM revenue, and you'll get the value of the enterprise value of the company. Now that enterprise value, again, is essentially, we are mimicking what the market does for the guideline companies by using this methodology. You can see that there are no adjustments that are being made here. It's just simply using the characteristics of the private firm and the expectation of the market for public companies in the space that the private firm is in to determine what the private firm's enterprise value would be. Now let's move from our simple example to some actual data using guideline firms from the health information industry. The PowerPoint in front of you shows firms within the health information industry, and it shows their expected growth, margin, cost of capital, and of course multiples. Note that G, the margin, and K are read off the left-hand scale, and the multiple is read off the right-hand scale. When you look at this PowerPoint, there are 2 points that seem obvious to me. One is that the expected growth in earnings, while it varies across companies, the range within which it varies is very narrow. That's number one. Number two, except for global sources, the cost of capital among these firms is about the same, or varies. They're different, but varies within a narrow range. Now, what does this imply? Well, first, let's go to the expected growth rate in earnings. Market participants in this particular case, namely stock market investors, informed investors, whether the individuals investing in these stocks or their agents, they are informed. They expect earnings to to vary by company, but within a very, very narrow range. Now, what does this imply? It implies that there's nothing unique across these companies to indicate that the growth rates are likely to be significantly different among companies. That is to say, in order for growth rates to be significantly different among companies, a company must have some unique technology, barrier to entry, other factor that's going to generate a very, very significant long-term expected growth rate. Hence, if there's a private firm in this sector that is exhibiting something unique in terms of growth, that is, in their projections, management is projecting rapid growth in earnings, the real issue is that is not fully aligned with what we know informed investors are thinking. And at this point, it would suggest that what management hopes is inconsistent with what informed market participants think. Now, it's true there are a number of caveats to this. Large public companies and guideline firms are larger, they're more mature, and often in many cases. The private firm is more in an early stage, so its growth is likely to be faster over some period of time. But remember what the expected growth rate actually measures. It measures the expected growth over an extended period of time. Extended period of time might mean 10 years. In this case, I've noted that example in the past. So, even for early stage companies, that their expected growth at some point should mirror what the long-term expected growth, I should say, should mirror what the market anticipates this long-term expected growth to be for more mature companies. The second point that I mentioned has to do with the cost of capital. Now here, the cost of capital, as you note, except for global source, that cost of capital also varies within a narrow range. You would expect something like this because the systematic risk that produces a cost of capital is very much similar across firms within the same sector, within the same industry. The third point that I'd like to make as it relates to this is that multiples tend to be high when profit margins are high. They tend to be low when profit margins are low. Now, in cases where the margin is high and expected growth is high, but the cost of capital is also high, as in, say, global source, then the multiple may be low because the higher cost of capital offsets the positive impact of a high expected growth and a high profit margin. So let's review one more time the inputs that go into our multiple valuation. So the cost of capital here is 15%, and the NOPAT margin is 10%. And the expected growth rate in earnings is 6.45%. Now, if we go ahead and input those numbers into the Gordon-Shapiro model, what we get is a multiple of 1.245. So just to round up, it's 1.25. That's the multiple for the private firm based on its profit margin and its cost of capital. Now, go back to the example that I used for the Guideline firm as an example. We started off there with a multiple of 3. And that multiple of 3 is really a function of the fact that the profit margin was the same as it is for the private firm, but the cost of capital is much different. And for the same cost of capital and the same earnings growth, the multiple for the private firm is a fraction, let's say roughly more than half of the multiple for the Guideline public companies. Now, this is the multiple that should be used, at least initially, to value the private firm. Now, let's just presume for the moment that there are other metrics, forgetting about what those other metrics happen to be, and those other metrics imply a value that is far greater than you would get from the multiple analysis we just did. So if we turn around and just say that for the private firm, based on a growth rate of 6.45% and a multiple of 1.25, let's just assume for the moment that the value of that company is somewhere in the neighborhood of $5 million, just for argument's sake. So this is not a small company. It's a company of reasonable size, but it's small by comparison to the Guideline public firms. Now, there's another methodology, or several methodologies, which suggest that the value is much higher. What's the implication of the difference? So let's say so we'll call this the multiple method, which we just did, and the second method would be method number 2, forgetting about exactly what it is, whether it's some sort of income method like discounted cash flow or based on recent transactions. It doesn't really make a difference, but just assume for the moment that this other method generates a value that's, again, for example, $10 million. Now, what does this actually mean? Well, the first thing it means is that because everything is the same, the cost of capital is the same. You're starting with a profit margin that is the same. Those profit margins may be growing based on projections, or however, whatever management is actually doing with regard to growing this company, whether it's revenue and then earnings are growing with revenue, or whether revenue is growing slightly but margins are increasing because of efficiency or productivity that management has implemented. But whatever it turns out to be, that this other method generates a much higher value. So what's the implication? The implication is that the long-term average growth rate using this other method must be very much higher than the 6.45% that we calculated. Now, what does this mean? Well, it means that there's a disconnect between these two methods. Now, often what happens is the analyst or the appraiser stops there and simply says, well, there's 5 million on one hand using one method and 10 million on another. Let's average it and call it a day. And that may be the right answer, as it turns out, but it's only the right answer coincidentally. What should be done is going back to management and looking at their projections, the reasonableness of their projections, whether in fact they've had a history of projecting a hockey stick and getting a broomstick. Again, you have to go back and look at that to see the reasonableness of the projections. The other is that the G, the 6.45, it will vary depending on the Guideline company, because each Guideline company now has a different margin, they have somewhat different cost of capital, and so the G's are different. So if I look at the G's and I say, well, all right, management, when I take a look at management's earnings projections, for example, or cash flow projections, they have an implied G of, say, 10%. And so then I look at the Guideline firms and I say, well, the range is somewhere between 5 and 8 on the Guideline firms. Now, 10 actually, the difference between 8 and 10 in this circumstance means a lot. So what might I do? Well, what I might do is go back to management and suggest to them that they need to rethink their projections. I would also go back to my multiple analysis and put in the 8% and see what that does. But typically what happens in these kinds of circumstances is this kind of analysis allows management to go back and rethink some of the inputs they used in their projections of earnings. And, it basically says to them that there's something that's not aligned properly. So for an example, if management was in the business of or wanting to sell the business, or the owners wanted to sell the business, and we did and they presented this valuation to what I'll call informed investors. It could be private equity investors or well-heeled private investors. In any case, they're reasonably informed. What would they do? I mean, they would go back and say your earnings projections over the long term are just simply, way too optimistic. And if we reduce those to something that's more reasonable, for example, the implied earnings growth rate of a set of guideline companies, we get to a different number. We don't get to $10 million in value. We get to something like 6 million, or perhaps even 7.5. The point being is that the averaging process is averaging, again, your ignorance. What you need to be able to do is go back and look at both methods, look at what the market participant earnings growth rates look like, and then also look at what management is projecting, and have a conversation about that. And as that conversation occurs, there should be more of an alignment.
We hope you enjoyed our presentation, The Use of Guideline Public Firms to Determine Private Firm Enterprise Value. In summary, in Part 1A and B, we showed how public guideline companies are not clones of the private firm to be valued, and therefore adjustments have to be made. We talked about how using multiples from public guideline companies directly to value private firms usually biases the value upward and leads to incorrect conclusions of value. Adjustments should be quantitative and not qualitative. In Part 2A and B, we looked at how to calculate growth using the Gordon-Shapiro model, and we show the equation here in the slide. We talked about comparing guideline firms' growth with Gordon-Shapiro growth calculated from the private company often shows widely different values, and when this occurs, adjustments have to be made. And we looked at value of the private firm from Gordon-Shapiro model versus the value forecasted by other methods, for instance, discounted cash flow. When the two are not the same, you should go back to management and discuss growth projections.